One early ownership stake in the right private company can outperform years of traditional investing. Most individuals in the United States never participate in startup investing simply because they do not understand how the system works. Startup investing is no longer limited to large venture firms. Individuals across the country now access private companies through structured platforms, angel groups, and professional networks. Access exists. The difference comes from discipline and understanding. Startup investing requires patience. When you invest in a private company, your capital is usually committed for 5 to 10 years. There is no daily trading market. Liquidity typically happens only if the company is acquired or becomes publicly listed. Any capital allocated to startups must be long-term capital. Early-stage companies raise funding in phases. Seed rounds support product development and early customer growth. Series A and later rounds support expansion and scaling. Most individual investors enter during seed or early growth stages when valuation is lower and uncertainty is higher. There are 3 primary access points for individuals in the United States. First, equity crowdfunding platforms. These online platforms allow private companies to raise capital from individuals. Investors can review company details, financial summaries, and offering terms before committing funds. Second, organized angel investor groups. These groups evaluate deals collectively, conduct structured review processes, and often invest together. Third, direct access through professional relationships. Founders frequently raise early capital from industry contacts, alumni communities, and trusted business networks. Investor eligibility determines which offerings are available. Individuals who meet certain income or net worth thresholds often gain access to broader private placements. Others participate through structured online platforms with defined limits. Regardless of access level, risk management remains essential. Understanding deal structure is critical. Most startup investments happen through priced equity rounds or structured future equity agreements. In a priced round, you purchase shares at a defined company valuation. Your ownership percentage is clear from the beginning. In structured future equity agreements, your investment converts into shares during a later financing round, based on predefined terms. In both cases, your return depends entirely on the company's growth and your ownership percentage. Valuation discipline separates professional investors from casual participants. Founders present vision and projections. Investors must focus on measurable traction. Revenue growth, customer retention, gross margin stability, and real demand indicators matter more than presentation quality. Strong leadership increases probability of execution. Many successful American startups adjusted their strategy before scaling. Founders who demonstrate operational discipline, industry knowledge, and responsible capital use reduce execution risk. Review their background, experience, and track record carefully. Diversification protects capital. Startup outcomes follow an uneven distribution pattern. A small number of companies typically generate most portfolio returns. Building exposure across multiple startups improves the probability of participating in a high-performing company. Concentrating capital in 1 or 2 businesses increases volatility. Ownership changes over time. When startups raise additional funding rounds, new shares are issued. If you choose not to participate in later rounds, your percentage ownership may decrease. Some agreements allow participation in future rounds to maintain ownership levels. Review these rights before investing. Tax structure can influence final results. Certain small business share structures may offer capital gains advantages if holding requirements are satisfied. Proper documentation and accurate record-keeping are essential. Private companies do not provide the same standardized reporting as public corporations. Due diligence requires reviewing incorporation documents, capitalization tables, shareholder agreements, and governance structure. Many venture-backed startups operate as Delaware C corporations due to legal clarity and investor familiarity. Deal quality varies widely. Strong opportunities often circulate through established investor networks and professional communities in cities such as Austin, New York, Miami, Boston, and Silicon Valley. When reviewing online offerings, evaluate whether experienced lead investors are participating. Professional oversight strengthens governance. Governance terms influence exit outcomes. Liquidation preferences, voting rights, and board representation determine how proceeds are distributed if the company is sold. Understanding your position within the capital structure protects expectations. Most startup exits in the United States occur through acquisition by larger companies. Public listings are less common. Study acquisition activity within the company's sector. Active buyers increase the probability of liquidity. Startup investing should represent a defined portion of your overall financial portfolio. Many experienced investors allocate between 5 and 15% of investable assets, depending on liquidity needs and risk tolerance. Track every investment carefully. Record entry valuation, ownership percentage, participation rights, and projected dilution. Performance becomes meaningful only at a liquidity event. Startup investing as an individual in the United States requires patience, evaluation discipline, diversification, and structured planning. When approached professionally, it becomes calculated exposure to early-stage innovation rather than speculation. Access alone does not produce results. Process produces results. Professional angel investors follow repeatable systems. Individual investors can apply the same structured approach. Deal sourcing determines opportunity quality. Experienced investors build relationships with founders, startup accelerators, and co-investors. Organized business communities and alumni networks frequently circulate curated deals. When using online platforms, evaluate transparency, historical funded company data, and communication standards. Before reviewing opportunities, define your sector focus. Healthcare technology, enterprise software, climate innovation, and consumer platforms operate under different cost structures and growth timelines. Concentrating on selected industries improves decision quality. A structured due diligence framework improves clarity. First, evaluate market size. Confirm that the company operates in a large and growing addressable market. Use credible industry research and competitor benchmarks. Growth requires market capacity. Second, assess traction. For revenue-generating companies, review recurring revenue growth, customer retention, gross margins, and expansion rates. For earlier-stage companies, evaluate pilot programs, signed commercial agreements, and measurable user engagement. Third, analyze unit economics. Understand customer acquisition cost and lifetime value. Sustainable companies improve margins as scale increases. Fourth, review capital efficiency. Examine monthly operating expenses and available cash runway. Founders who raise capital tied to clear milestones demonstrate financial discipline. The capitalization table deserves careful attention. Confirm founder ownership percentage, employee equity allocation, and existing investor classes. A clean ownership structure simplifies future fundraising. Review legal documentation thoroughly. Confirm proper share issuance, board approvals, and defined shareholder rights. Understand liquidation preferences and information rights included in the agreement. Information rights determine how frequently investors receive updates. Consistent financial reporting indicates operational maturity. Capital deployment timing affects risk exposure. Instead of allocating your entire startup budget in 1 year, distribute investments over multiple years. This reduces exposure to a single market cycle. Valuation discipline remains critical. Compare valuation to revenue multiples of similar stage companies within the same industry. Price must align with measurable performance. Reserve capital for follow-on investments. Increasing allocation in companies demonstrating strong traction can improve portfolio outcomes. Planning reserves from the beginning prevents missed participation opportunities. Geographic ecosystem strength influences growth probability. Silicon Valley remains a major funding hub. Austin, Miami, Boston, New York, and Denver demonstrate strong startup activity across specific industries. Regional funding depth supports expansion. Sector-specific risks must be evaluated clearly. Healthcare companies may face regulatory review timelines. Financial technology companies navigate compliance requirements. Enterprise software companies depend on enterprise purchasing cycles. Industry structure shapes growth pace. Develop conservative exit models. Estimate acquisition multiples based on comparable sector transactions. Model dilution across future funding rounds. Calculate potential ownership at exit to understand realistic scenarios. Startup investing requires patience. Many venture-backed companies take 7 or more years before liquidity events occur. Long-term planning is essential. Maintain organized records of all agreements, ownership percentages, and holding periods. Structured documentation supports reporting accuracy and exit execution. Co-investing alongside experienced lead investors strengthens governance. Lead investors often negotiate terms and monitor performance closely. Their oversight improves accountability. Communication frequency reveals leadership quality. Regular financial updates with transparent performance metrics demonstrate operational control. Invest only in companies with transparent governance and lawful business models. Responsible capital allocation supports sustainable growth. Secondary share transfers occasionally provide limited liquidity before exit. These transactions require company approval and legal review. Treat secondary liquidity as optional rather than expected. International expansion introduces operational complexity. Startups entering global markets must demonstrate execution capability and regulatory readiness. Industry expertise provides analytical advantage. Investing within sectors you understand improves evaluation accuracy. Startup allocations must align with overall financial planning. Illiquid private investments should complement diversified holdings in public equities, real assets, and cash reserves. Conduct annual portfolio reviews. Categorize companies by growth trajectory and operational stability. Allocate follow-on capital based on updated performance data. Startup investing as an individual in the United States operates within a defined structural framework. Success depends on disciplined sourcing, rigorous evaluation, valuation awareness, portfolio diversification, and long-term patience. With structured decision-making and professional standards, it becomes strategic exposure to early-stage innovation within a diversified investment strategy.